Good afternoon, everyone, and welcome to the Merced County COVID-19 Small Business Resources webinar. My name is Mike North. I'm the Public Information Officer for Merced County Emergency Operations Center, as well as the moderator for this event. Today, we're going to hear from Merced County's federal government relations firm, CJ Lake, as well as David Marioni, Merced County's Assistant CEO and Director of Worknet, Merced County. A couple of quick housekeeping items before we get started. Once we go through today's presentation, we'll have time at the end for Q&A, so please feel free to start asking questions now in the menu on the right-hand side of your screen. This webinar is scheduled to end at 4 p.m., so we'll answer as many questions as we can within the allotted time. If we're unable to respond to your question, feel free to email it to business@worknetmerced.com. Again, that's business@worknetmerced.com. And please keep in mind, questions for this webinar should pertain to small business and nonprofit resources available due to the COVID-19 pandemic. Again, thank you all for being here. And with that, I'll turn it over to Amelie Baca with CJ Lake. Emily?
Thank you, Mike. Hi, it's Amelie Baca with CJ Lake, and I have my colleague Chris Schulte here as well. Today, we're going to be running through the Families First Act as well as the CARES Act and provisions that can assist small businesses. Next slide, please. So the Families First Coronavirus Response Act, known as FFCRA, was signed by the President on March 18th, which seems like a lifetime ago. The focus of that legislation was really twofold. It was free testing for COVID-19, and then it also included paid family medical leave as well as paid sick leave. And of course, that was effective 15 days after enactment, which was April 1st. And then Congress passed the CARES Act, the Coronavirus Aid, Relief, and Economic Security Act. That was signed by the President on March 27th. And while Families First really focused on the emergency, CARES was drafted and passed to really focus on mitigation. It totaled over $2 trillion in relief. And to put that into perspective, that dwarfs the stimulus from 2009, which totaled $800 billion. There were a number of kind of key components of the CARES Act. There was, focus on relief for individuals, and people are starting to see those deposits into their checking accounts or their banking accounts this week. There was funding included for states and locals. There was quite a bit of funding for healthcare providers. And then there was a focus on industry and specifically small businesses. The centerpiece of the SBA program really is the Paycheck Protection Program, which I'm sure a number of you have heard a lot about over the course of the last few weeks. And you may have even heard that the program exhausted its funding today. We are going to go into detail about that program because Congress is currently negotiating to include an additional $250 billion into that program. Next slide, please. There are several key provisions for small businesses that we'll touch on today: the paid sick leave requirement, paid family leave requirement, the notice requirement, and then loans and grants, both from SBA and Treasury. My colleague Chris is here and he will now take over.
Thanks, Emily. We'll start with the Families First Act and the paid leave and provision. So it's paid sick leave and paid family leave. Here's some basics of kind of who is covered. It's meant to address small employers. So those are businesses with fewer than 500 employees. To some, it seems kind of unfair that they're putting the requirements on the smaller employers. But as you'll see toward the end of this discussion, the structure of this is that all of the leave that is paid is reimbursed in full by the government. So the idea was they didn't want to essentially have taxpayer dollars funding, very large companies. So companies like Walmart or Amazon or Google were expected to provide their own paid leave, and they would be taken care of that way, rather than have the government step in to have to pay for that. This was meant to kind of really assist in smaller businesses like this to make sure that they're able to provide this leave to their workers. The measurement of 500 employees, it's a snapshot basically that's taken at the time that the leave is taken. So it's not really, unlike some of the other programs, we'll talk about in a little while under PPP or something like that, where they look at an average over the last year. I mean, this is really looking at how many workers you have at a given time. And so for seasonal businesses where that number may come and go, that may end up with different outcomes depending on when this happens, when the leave is requested. It includes all employees anywhere in the United States if you have multiple locations for your operations. It doesn't exempt seasonal employers or seasonal employees. And basically, a part-time employee is just an employee. It doesn't use a full-time equivalent analysis like they did for something like the Affordable Care Act, where they would kind of combine two 20-hour workers and treat that as one FTE. Here it's an employee. That's as long as they're on your books right at that moment, then they are counted. They also do something called the Integrated Employer Test. That was an existing test under the Family Medical Leave Act. The difference is for the FMLA purposes, that didn't apply until you got over a certain amount, whereas here the number is essentially a ceiling on the number. So it's a slightly different calculation, but they're basically looking to, are there multiple companies that have shared ownership, shared management, interrelated operations, kind of central control, really, is it, 4 separate corporations or sort of 4 divisions of the same overall entity? And there's some discussion in there on the joint employer test. They look to kind of who really has control over it. It's looking at the federal standard. In California, there's a slightly different standard for some employers, things like farmers and farm labor contractors. There's language there. But basically the idea is, is it really one company? Is it combined to get there? There is a very limited small business exemption we'll talk about in the context later of where their child's school is closed and they're required to be home caring for the child. Basically, it's if there are 50 or fewer employees and losing that employee to them being home would essentially, cripple the business and make it so that they couldn't continue to operate. It would be such a devastating loss that they wouldn't be able to operate. Then there's an exemption just for that. But again, it's limited to those very, very small companies and to the situation covered by the extended leave for child school being closed. These are the 6 different events that can trigger paid leave. The first 3 essentially are sick leave, where the employee themselves is sick. 4 and 5 are where they are caring for someone else because of COVID-related reasons. Number 6 doesn't exist yet, but is sort of a placeholder to the extent that Secretary Azar at Health and Human Services consults with Secretary Scalia, Secretary Mnuchin to define some other event that could be included in this list. That would fall here. There are no such events so far. So we're really looking at these first 5 events. Number 1, the employee is subject to a government quarantine or isolation order. There's been a disagreement here as to when it came out. Some members of Congress believe that this meant people that were covered by essentially something like Governor Newsom's stay-at-home order. That's not what they meant. And so the DOL guidance out there has said, no, this is literally, they were using the term basically as the CDC used it. So a quarantine, from their perspective, is someone has been exposed to someone who is specifically COVID positive tested, and they are watching them to make sure that they do not develop the symptoms. Isolation is they have been tested and they themselves have tested positive for COVID, and so they are subject to an isolation order. So they're not allowed to interact with other people because of a government order. For purposes of employers documenting this, there's no specific form from Department of Labor to kind of determine when these are triggered. There's no requirement that a worker provide a doctor's note, for example. But the worker does have to indicate to the employer kind of that they are requesting this leave and this is why. And so for number 1, the documentation would just be they would need to identify the government entity that ordered them to be under quarantine or isolation. So again, it's not a blanket order on the countywide or statewide level. This is specific to a given individual that is has a medical condition that requires them not to be able to come to work. Number 2, similar idea, but it's their medical provider. So it's not a county health officer telling them to do so. but it's, Dr. Jones at Mercy Hospital told me that I have to stay home, because of COVID. And again, you notice on here there is no condition here for somebody who has a pre-existing condition. They're immunocompromised, or they're concerned that they will develop it. This is people who are testing positive or are presumptive to have it. It's specific to this, and it doesn't cover other kinds of leave if they're out sick for any other reason that is not specific to COVID-19. They're not covered by this. So for number 2, they just identify the doctor who told them they need to stay home. Number 3, they're experiencing the symptoms and they're seeking diagnosis. It's not just, I've had this cough for 3 days, I'm not going to come into work, so I need to be paid for leave. Existing California paid leave may cover that, or your company's policy may provide them sick leave, but that's not leave that's necessarily going to be reimbursed by IRS. It needs to be showing the symptoms and then seeking the testing diagnosis. And it's been harder to get the testing than I think was originally intended when they passed this law back on March 18th. But that's the idea, that it's targeted to this specific thing. Number 4, they're caring for a quarantined individual. So under the FMLA, they would have definitions about who you'd be caring for, who needed you to be there to trigger the family leave. That's the unpaid, pre-existing FMLA leave. And so it would say spouse, brother, sister, parent, child, things like that. Here it's just individual. So that they need to be there caring for somebody who has been quarantined, who's under either a government order or a medical order. And then number 5 is more common. This is where your employee is caring for their son or daughter. And so those were the words that were used in the statute, and that's how DOL is interpreting it. So in cases where, say, a grandparent is the primary caregiver, that may not qualify. It does include, obviously, adopted children, foster children, but it's son or daughter. And their school or daycare is closed because of COVID. So essentially all the schools in California are closed, so that could be covered. The documentation there is just that you would provide, the worker would provide the name of their child, the school that they would go to, and just they would attest, or they would say to you as the employer that there's no other suitable person who can care for the child. And so that's why they need to be home. For the sick leave, this is essentially where one of those first 3 conditions where they're under medical directive or government directive to stay home because of the disease. They're entitled to up to 2 weeks or up to 80 hours. It may be more than 80, it may be less, depending on their schedule. We'll talk about that in a second. At their regular rate of pay, so at full 100% pay while they're under that. So there's a daily cap on that. That's a fairly high hourly rate, but that is in place. And so those are the limits for what the employer is required to provide, but on the other side, B, what IRS will reimburse to the employer for doing so. Family leave is, again, 2 weeks up to 80 hours, but this is at 2/3 of the regular rate of pay to care for somebody. And then there's an additional 10 weeks, so 12 weeks total, to care for the son or daughter where school is closed. This is the only one that requires them to have spent a certain amount of time with the company. If somebody is hired and later that day they develop symptoms and they have to go out sick, they're covered immediately. There's no kind of vesting requirement like there would be for other kinds of healthcare or insurance purposes. To be able to access the extended leave for caring for the child, though, they just need to be on payroll for 30 of the previous 60 days. In the original Families First, it said the last 30 days, but for some people, they had let go some of their workers and then rehired them. And so basically, if they'd showed that they'd done even a month's work in the last 2 months, that they would be covered. Again, these are limited. There's some overall dollar caps as far as pay per day and pay per week, or for the maximum total pay. And so on the childcare provision, they have the option. Again, it's totally at the employee's option. The employer can't force them to do so, but they have the option to take those first 2 weeks using their paid time off through the company. So they would essentially get up to full pay for 2 weeks and then have 10 weeks at 2/3 pay. But it's up to them. I mean, they're entitled to the 2/3 all the way through, but that's it. If someone, say you have a situation where somebody is sick for 2 weeks and their child's school is also closed, so they would be using both, it's not 2 weeks plus 12. The 2 week counts out of the beginning, and then the 12 is the absolute maximum. Here's some other provisions around there. It's figuring out how many hours per week they would be paid, and so this is for either people on irregular schedules, or potentially for part-time workers, or people even that would work a longer than 40-hour schedule. You'd look at their average number, how many they were scheduled for, and then if you weren't sure what that was going to be for the coming 2 weeks or 12 weeks potentially, you can use a 6-month look back to the extent there's variation. So say you had somebody who normally works, their average worked out to be about 25 hours, they would still get 2 weeks of pay, but you would only have to pay 50 hours and not the full 80. Whereas if somebody was scheduled to work 50 hours in a week, they would get paid 50 hours in week 1 and then 30 hours in week 2. So it's whichever the two you hit first, 2 weeks or the 80 hours, that's the maximum. If you have somebody that can work an intermittent schedule, say they're 2 parents and they can split shifts to take care of the children. So one can work 3 days a week and the other can work 2 days. To the extent they can come in, they don't get paid time for that, obviously. They just get paid for their work on those days, including telework. They don't have to physically come into the office. If they're able to telework, that counts as work and they don't get paid leave for that. But if they could come in on an intermittent basis and they would have been in there otherwise, but for being home to care for someone, they're paid for the time they work, and then they would be eligible for the 2/3 for that other time. It's not as likely as somebody that's sick and then can come in on an intermittent basis. Usually if they're in quarantine, that applies for the full 2 weeks, but this would be for the childcare scenario. For regular rate of pay, for some people it's straightforward. If they're on salary or have a fixed hourly rate, exactly what that is, straightforward. If it's variable, people that are paid on kind of a piece rate or kind of tipped employees, things like that, there are ways to kind of figure out what their average effective hourly rate would have been. Again, you can use that 6-month look back. You kind of figure out their total pay divided by the total hours. That gives you basically an idea of what their effective rate would have been for that time. And you either pay all of that for sick leave or 2/3 of that for the family leave. The pay comes out, it would be treated as W-2 wages. IRS has indicated that it is taxable, essentially, and subject to normal tax treatment. We have not had guidance from Division of Revenue for California, but that it would be treated as taxable there for those purposes, considered against your workers' comp total for earnings, things like that. It is essentially earnings or wages for the worker. It just happens to be reimbursable through the government. And there are anti-retaliation rules. Obviously, workers can't be fired for requesting the leave or challenging an employer's decision on that. The U.S. Department of Labor has enforcement jurisdiction over this. They've indicated that they will have what they call a non-enforcement policy, quote unquote, for the first 30 days it's in effect. So essentially for the month of April, if the employer doesn't pay and they should have, DOL will come in and say, no, you should have, you were meant to have paid that person for that time. The employer can pay that, and there will be no penalties attached to it. They'll just get straightened out with the worker and move on. And this is in addition to California paid leave law. So there's existing requirements under California law. This does not preempt those. It is in addition to those. Now the good news. So we've laid out all the things that you have to do and all the places to be careful of. The good news is this was a key part of Families First, is that the government will pay for that. So if a worker goes out on leave, the employer pays that as part of the regular payroll, but then they are reimbursed dollar for dollar through the IRS. The number one mechanism to do this, and for most employers this will cover it, you collect the amount that you would have paid in for all of your workers, not just for that one worker, but for everybody, the FICA portion of it, so it's 6.2% of their earnings, part of their payroll tax. You would normally be paying that into IRS periodically. You're allowed to keep that, and then you would report to IRS, say we collected $5,000 in FICA taxes, and we had 1 or 2 workers who were out, and the cost for that to us was $2,000. So we're going to just keep that $2,000 to square that up, and then we'll pay you the $3,000 on top. That's extra. So again, it's not specific to those workers, but it's kind of across the entire business. If it's the other way around, though, say you have just a few workers, but you have 6 or 7 people that are out, and so you collected $2,000 in FICA taxes. that you would have paid in, but you had a $5,000 cost to provide the leave. Now you're $3,000 short. IRS will pay you, will provide that difference. So you want to look for IRS Form 7200. There are instructions there. The form itself is only 1 page long, very quick. The instructions are obviously a little bit more detailed, but that's the idea, that there's a way to file that. They will process that as a credit to you. Their goal is to get that out in a week to 2. They've been a little slow, obviously, in the rollout, kind of getting everything done, but there's a setup that's meant to be pushed out as quickly as possible, as close to real time as you're handling your payroll. And again, it covers all employees. So if it's an S Corp and somebody, the owner essentially owns it, but they're not paid as an employee, they don't receive a W-2 from the company, for example, they may not be considered an employee. There's no inquiry here as to social security number, the worker status, things like that. IRS so far has not given any indication that they are involving Homeland Security. That's not what they do on these tax issues. So if you have an employee, they've completed a 9-9, they're for all purposes, they're your legal employee and they are covered by this. So that's the good news on Families First, so that the government will take care of this, and then you will be made whole for anything that's paid out, and so that should all cancel out. So from the employer's perspective, the worker may be missing from the work site for a period of time, but there will be no financial hit to you for that payment. We'll cover briefly the Paycheck Protection Act, Paycheck Protection Program, usually referred to just as PPP. You probably heard that there's an announcement from the White House this morning that the funds for that had already run out. And so there will be another round. Emily will talk about that in just a little bit. But just sort of for purposes of the way it was set up so that you understand basically what's there. Some of you may have already applied for it and gotten the funding. If not, if you haven't yet, and it's something that when round 2 comes out, hopefully very soon, you'll just have some background so you can go in and know what to expect. So it's subject to Small Business Administration size restrictions, generally 500 employees again, but there are other rules about, affiliated companies, and there are other ways to measure size. Depending on the industry that you're in, they look at the industry code. There's sometimes earnings thresholds, so that even if you're over the 500, if the earnings levels are met, you can still qualify through different ways. Like a lot of the programs that are coming out of the CARES Act, it is handled through private lenders. So it's not something that you have to send into Washington and then they'll send you a check back in X number of weeks. It's handled through your local bank. So the money is pushed out to the banks and then the banks lend it on to people. The basic way to do it is that the maximum amount is 250% of your average monthly payroll for the same period last year. For non-seasonal businesses where you have pretty steady earnings across the whole year, they will essentially take your total payroll for the year divided by 12 and then multiply that by 2.5, and that's the amount that you can get for the loan. There are different things that can be used. It's primarily used to cover your payroll. So to the extent that you're using a staffing company, or in the agricultural context, you'd think of people using a farm labor contractor. It's not really covering labor costs like that. That's an expense to the business, but it's really meant to cover your payroll for your employees. It can include paid time off, compensation up to $100,000. It can cover utilities, rent, mortgage, interest on other loans. But the guts of it are really that it's meant to cover your payroll. This was sold as kind of a catch-all. It's free money. It's going to be great, but it really is meant to kind of keep your payroll up. And there will be loan forgiveness to the extent that you can show that you maintained your payroll for an 8-week period beginning on the date that you got the money. So whenever that happens, say you get the money on May 1, for those next 8 weeks, you want to be able to show that you were able to get to your normal payroll from that same period the year before. And so that could be that you retain that number, or to the extent you'd let people go and were able to reopen or kind of ramp back up. Because of this, it can just be people that are rehired or new people hired, and they're looking at a total head count, not that the individual people are exactly the same. And to the extent there's any amounts that are not covered by that forgiveness, either the total payroll level is lower or whatever, it's payable over time at a 1% interest rate, so very low interest. As we mentioned, the program was hit already, so $349 billion went very quickly. It lasted about a week and a half. That's roughly the cost in 2020 dollars of what it costs to build the Great Wall of China. So it's a good chunk of money, but we burned through it pretty quickly. It suggests how deep the hole is that we're facing. California small businesses, this is as of a few days ago, had gotten the most out of any state in the country. It makes sense, the most people of any state in the country. So they've gotten about 21 billion out of that. So that's a little over 5% of the loans, about 8% of the funds. So they tended to have slightly larger average loans than some of the other parts of the country. Here's a sense of some of the sectors, subsectors of the economy, where, kind of how many loans. This is again as of April 13th, kind of who's getting it. And so what's interesting is it's not necessarily the people that are hit hardest in the economy, because in order to get this funding, you need to maintain your operation and still be up and running. So places you'll see things like retail and food services and hotels, they're there, but not as high up as you'd expect in the economy, because a lot of them, unfortunately, are closed down, and so they would not be getting this funding. If you have a business where you are, the governor deems that you're not essential, quote unquote, or you're subject to a shutdown order, or because of other people having to stay home, you have to close your doors because the customers just aren't there. The PPP would not fit for that, because it's not paying people, to not work. It's to the extent that there's a danger to the business because of what's going on, but you're essentially up and running. Like construction here in a lot of the country, construction is continuing in spite of all this. So they're still going. So that's why they have the most loans. Manufacturing, that's still up and running in a number of places. So to the extent that you have furloughed your workers, they would be, paid their regular rate of pay plus some under the CARES Act through the unemployment system. And then there are other loans that Emily can talk about in a second that would cover operational costs, to the extent you still had rent or mortgage on your property while you're closed down, that would cover that. But PPP is unique to kind of ongoing businesses that are able to keep going and just use this money to kind of keep their folks on payroll and kind of keep a level earning. So I'll pass it back to Emily to talk about some of the other loans that may be applicable to you.
Thanks, Chris. Yes, as Chris mentioned, I think the focus and in the news, people have really been talking about the Paycheck Protection Program, but we want you to know that there are some other tools out there that you may not be thinking of that SBA has. There are, 3 that we listed right here. First off, the Section 7A loans, they offer up to $5 million. Those are private loans again, and they can be used for working capital, expansion or renovation, new construction, purchase of land or buildings, purchase of equipments and fixtures, leasehold improvements, refinancing debt, seasonal line of credit, or inventory. So again, that may be one to look into. Another one is the 504 loan program, and those were designed to foster economic development and job creation and or retention, and those can be used for the acquisition or eligible refinance of fixed assets. Again, on those 504 loans, the max is $5.5 million. And then, of course, there are some smaller micro loans. I just looked today, the average is up. They were $13,000. Now they're up to 14 with a max of 50,000. So again, much smaller. And those are actually through nonprofit lending organizations, mostly focused on underserved markets. Again, the authorized use of those loans include working capital, supplies, machinery, and equipment and fixtures. Next slide, please. Now, these are 2 that you may have heard of through the CARES Act, the Economic Injury Disaster Loans, and then the the Emergency Economic Injury Grants. The EIDL, those provide the necessary working capital to help small businesses and nonprofits survive until normal operations resume after a disaster. So these were already a tool that SBA had. They're low interest loans up to $2 million. I think what's interesting and what people have heard about through the CARES Act is the emergency economic injury grants that are now a part of that. And the idea of those emergency grants is that you could have $10,000 payable within 3 days to an eligible entity who has applied for an EIDL loan. And then the grant must be used for payroll cost, rent or mortgage, or debt obligations. Now, I've heard a lot of problems, that there are a lot of problems out there with the EIG, and that folks aren't able to get through, or if they are, they are not receiving this funding within 3 days. I do know that members of Congress are very aware of this problem, and just today I saw a bipartisan letter, probably close to 50 House members sent a letter over to SBA, explaining that they are hearing from their constituents that there are these problems and that SBA needs to find a way to address this. Again, with the legislation that we hope is coming within the next week, there could be some additional funding for EEIG. The other thing I would note about the EIDL is that if you file for a loan and you receive the $10,000 grant, but then decide instead to utilize the PPP loan, the $10,000 grant will be reduced from the forgiveness portion of the loan. So, as we've been talking to folks who may be interested, again, we say, go to your local lenders and just work with them to evaluate both programs and then choose accordingly. Next slide, please. And then one other program that you may not have heard about that was also included in CARES is the Main Street Lending Program. And as Chris was discussing with PPP, that was focused on small businesses in general, those businesses that have less than 500 employees. So the Main Street Lending Program was really to capture those mid-sized businesses, so anywhere from potentially a little bit over 500 to 10,000 employees. And interest rates on direct loans to mid-sized businesses wouldn't be any higher than 2% a year. It waives the payment of interest and principal on the loans for 6 months, but this period can be extended at the discretion of the Treasury Department. Again, the one thing about this Main Street Lending Program, these loans cannot be forgiven. And so, people say they don't seem quite as attractive as PPP. But again, for those who may not qualify for PPP, this could be an option. The other issue with these loans, funds received must be used to retain at least 90% of a recipient's workforce at full compensation and benefits until September 30th. And then in terms of additional assistance, as I mentioned at the beginning, the Families First was really to address the emergency, and then CARES was, to address mitigation. We think right now, we're still in mitigation mode. Right now, the focus is replenishing the PPP funding. As I said, negotiations are currently underway, and we hope that they reach a deal, this weekend or early next week, if possible. There will be, additional funding. They're talking about $250 billion for PPP. In addition to that, it looks like there could be funding for state and locals, funding for hospitals, and potentially an increase in the SNAP benefits that would be included in this package. Beyond that, Congress is currently out of session and is not expected to return to Washington until May 4th. I think when they do, there's going to be a shift in focus on what people are calling CARES Act 2.0. It seems as if there's just not enough funding to go around, as you could see with PPP. And so, folks on the Hill have been talking about additional assistance to individuals, additional funding for unemployment, potentially even, additional from the IRS that would go to bank accounts. So I think there's going to be a number of things they're looking at for that. And then there's also talk of, potential assistance for employers and workers in a 2.0. In terms of kind of what you can do right now, I would check the SBA website. It gives a good description of, the various programs that are out there, in addition to farmers.gov on the USDA website for farmers. And then, as I mentioned a little earlier, your outreach to local lenders, they will be the folks who can walk you through the steps if you are going to move forward with any of this federal assistance. And I know David is on as well, and he's going to focus on some of the county and state programs that are available to you all.
Good afternoon, everyone. This is David Marioni. I am the director of Worknet, Merced County. And just to give you a quick overview of what Worknet is, the most simplest way to think about it is each year you'll see the president, doesn't matter which president, talk about getting Americans back to work, typically in a State of the Union address, putting people into training, helping people find jobs. That is done through a system through the Department of Labor where they fund job centers. So in Merced County, that is operated via the Worknet Merced County system. So we have two centers, one in Merced and one in Los Banos. You can find all of our contact information on worknetmerced.com. And so one of the programs that we launched about a year ago that we feel would be really strong right now to help the business community is a service where we have partnered with the California Employers Association to provide all Merced County employers with a no-cost human resources hotline. So many of you on the line may not have HR staff, or you may be running a business that's very large with HR staff. What we have seen is the smaller businesses have used this to get advice on hiring and firing best practices, sick leave, wage and hour laws, handbook policies, HR compliance, accommodations, basically a second opinion a lot of the times as well. What we've seen with larger companies is it becomes a tool in the toolbox for your HR team or your HR manager. And so they do have high-level HR staff on hand. So as we start to go through the rollout of these programs and leaves and calculating accruals and hours and what do employees qualify for, we hope this would be a good resource for you all to use. That number is 888-906-0041. Next slide, please. So just a quick overview on some of the other services that we have. So right now we're really focusing on the services that are, that our colleagues just touched on. So we do have information on the loans and tax exemptions. There is one that's California specific out there called the California iBank loan. So think of like an iPhone, iBank, the letter I in the word bank. There's information at ibank.ca.gov. And that's a loan for businesses with 1 to 750 employees that have been negatively impacted by COVID. When you go on there, there's all of the details on those loans, the thresholds, the guarantee amounts, as well as a list of lenders that are authorized to help you fill out the applications for these particular loans. We partner with the Employment Development Department. Their staff are in our centers. Right now, our centers are closed to the public due to COVID-19, but I do have staff in the offices answering the phone as well as via email. There's a program out there called WorkShare that the governor recently spoke of about really starting to try to enhance that program. And what that program does is it allows you to, instead of laying someone off, maybe you take 2 people down to 20 hours and those 2 impacted employees can pick up a partial unemployment payment. That's especially helpful for staff that may be in jeopardy of losing health care, if you need to keep staff on board, but you don't want to lose them during this time. That's a tool that is often not as used as you would think, and the governor's really taken another look at how we can enhance that program. We do partner with the Small Business Development Center, SBDC. They are right in the forefront of many of these applications. As when you become in a situation to start hiring again, some of our services that we offer, we will help run recruitments for your business to help you find people. We do help about 500 various businesses throughout each given year and have about 16,000 people come through the doors throughout the year looking for work or looking to increase their skill set. We do provide training opportunities for job seekers. And one of the programs that we do is we fund some of the local schools to provide training opportunities for our job seeker clients. But as many of you know, some of the training that you provide is so specialized to your particular industry that the school system would just not be in a position to provide that training. So what we do is we work with employers to create what's called an on-the-job training plan. So you hire the folks, come up with a plan together, and while those new employees are in a training mode, so let's say it's a 40-hour week and 30 of that is training, we reimburse you 50% of that wage. So we'd cover 15 hours, you cover 15 hours while they're training, and then the 10 hours of productivity you would cover. Many of our trainees, often it's 40 hours, so we're splitting it 50-50. Through that process, we typically go up to about $5,000 a training program. We do have other programs where we receive federal dollars to actually place folks with employers. And if they hire out of a particular pool of candidates that we have, we can reimburse 100% of the wages for the first 4 months. So that will be a good tool that you can keep in your toolbox as you start to hire again, if you've gone through the process of some layoffs or furloughs. Again, we do have the ability to help you with online job postings. We open the center up if you want to do interviews there. So when we get out of the whole shutdown and stay at home order, we are here for you to help you get back in business. We are keeping information updated at worknetmerced.com/COVID-19. Next slide. Okay, so that concludes the Worknet side of the presentation.
Okay, thank you, David. Now we'll take some time to answer some of your questions, the first of which comes from Justin. Justin says, I have a hypothetical scenario that no one has been able to answer, including bank officers that are administering these loans. I know that once the loan is funded, you have 8 weeks to spend it on specific areas like payroll to have it forgiven. I have also heard that all your staff needs to be rehired by June 30th. This date is a concern for me. If this loan is funded next week and the 8-week window starts, I would need to rehire my staff at that time. My line of work's closure is indefinite based on the recommendations of the Department of Public Health and our governing body. So these funds would be used to pay my staff while they were at home and not working. This would take me to the last week of June. If my office is still supposed to remain closed at that time, which is a distinct possibility, I would need to place my staff on furlough again at that time. So here's my main question. If my staff files for unemployment again on July 1st or soon after, does this disqualify me from loan forgiveness, despite the fact the funds were used properly during that 8-week window after it was funded? Emily, do you and your team want to take a crack at that one?
Hey, Mike, I'll jump in first. This is Chris.
Chris.
First of all, if the business is currently not in operation because of that local shutdown order and the workers have been furloughed or let go, PPP probably isn't the right fit in the first place, because that's really for businesses that have everybody already on staff or nearly so, or could bring them back on short notice to kind of be up and running. If they basically have to have their doors closed for the short term, that's not as good of a fit. Something like the EIDL loan is probably a better operation for that, to cover things like, there may still be rent or mortgage or loan fees to do with that, or reduced, but still utility costs or something like that, it can cover those things. PPP is really for people that have most of their payroll still in place. To his point, though, to the extent that the loan has already been taken or is taken out, and then the worker, say, your measurement window goes until June 30th, and things get much better, and so we get to June 23rd, and so you get a good week of work in where people come back. You'd cover that week of wages, bring everybody back in, turn the lights on, get everything going, pay them for that. If you had additional amounts, those amounts wouldn't be forgiven, but could be repaid to the government or to the loan or to the lending bank more specifically. There's specifically no penalty for early repayment. The interest rate, as we mentioned, is only 1%, and the first payment isn't due until for 6 months. So you would have the opportunity to essentially just say, I didn't end up needing all of this part of it, so I'll just repay that to the bank and be done with it. And then the part of it that had been used for payroll, that would be forgiven. And so, you wouldn't owe that back. And so by the time you get to the end of that period, that's it. You can wash your hands of it and be done. On the possibility of, to build on this, the hypothetical, if things did reopen or didn't reopen, or say they did and then had to close back down or whatever happened, and the workers went back on unemployment later because you had to reclose the doors for some reason. We thought things got better and then they got worse, something like that. Once you're outside that 8-week window, there's no more duty to kind of keep them on. It's specifically to that window to kind of maintain over that short-term bridge period. Once you got beyond that, it could be that you had to downsize again later, and there would be no problem with that. They're really looking to kind of that snapshot, that window of 8 weeks, and kind of maintaining payroll for that. So again, PPP not really a perfect fit for that because there isn't that existing payroll obligation. To the extent there's a future obligation, some of the other loans are probably a better fit for it. But there's ways to kind of, as it comes on, that part of it could be forgiven. And if they went back onto unemployment, then that shouldn't interrupt things. But for most places where the business is closed because of either a stay-at-home order or just reduced demand because of the economic situation, the workers are being taken care of through the unemployment system. That's kind of what that's set up for, and then the separate loans would cover the employer side of it. So if you made that offer to bring them back, that could potentially take them off unemployment and kind of jeopardize their ability to receive that. So it's something to think about. I mean, with the additional money that went into unemployment through the CARES Act, the workers should be receiving, basically at their current level or possibly a little bit higher even. There's a break-even point. In some places, it's about $22 an hour, at which the unemployment is more profitable to the individuals. But anyways, the question is, PPP probably not the best fit, but there are ways that could be handled to the extent that you can use some of the funds, but maybe not all of the funds.
Okay, thank you, Chris. Our next question here comes from Laura. Laura asks, is there another rate on childcare if a company is under 25 employees? If a company is under 25 employees, we are not required to cover issues with daycare being off. Chris, Emily, is that one you can address?
Yeah, I'll take that again. So again, if the employer has under 50 workers and having a worker go out to care for children would, and there are specific conditions in the Department of Labor guidance that essentially that's the only person that can do that, that can fill that position, and having them be absent would jeopardize the company's viability, essentially to that level. Then that's the only kind of smaller business exemption on that end of it. And again, specific to the school closure issues, they just flagged that exactly. But you have to make a showing to the Department of Labor that being without that person would be catastrophic to the business, basically.
Okay, thank you. Our next question comes from Leticia. She asks, if an employee was out due to another health issue for several months, but was scheduled to come back during this time, but was told by her medical doctor to stay home during this time since she is immunocompromised, does she still qualify for this?
No. No, so they would not qualify for the Families First coverage for the 100% payment and then the reimbursement through IRS. If the company has a policy to cover that time, that may cover it, or if there's California state paid time, more likely that would be covered by the regular Family Medical Leave Act, where the position will still be offered to them when they return, but they wouldn't be eligible for the paid time. It has to be either an order of quarantine from the government, an order of quarantine from a doctor, or they've demonstrated specific symptoms and are seeking testing or diagnosis for that. Other conditions that they may be perfectly justified in wanting to stay home, but it's just the way the law is set up, it does not provide pay for that.
Okay, thanks, Chris. Our next question comes from Raquel, asking what would be the best loan for a sole proprietor contractor that only uses subcontractors to help cover utilities, mortgage, sub payments, etc.
Go ahead, Chris.
Go for it. No, go for it.
I would say, honestly, PPP would not be the one for you, but I would say I think you need to talk with your local lender and work it through with them. I don't know that Chris and I are the experts in which one you should choose, but Chris, if you have something else to add, please do.
That's exactly what I was going to say. Yeah, PPP wouldn't be a fit because the payroll wouldn't really be your issue. It's more the operating expenses, as you pointed out. And so each carries different limits. The size limit would be okay. So one of the small business loans would probably be a good fit. But I would check because they have different interest rates and repayment schedules and different things that they're eligible to cover. So that could be the 7A, it could be the EIDL. It kind of depends on, to the extent that you're responding to losses because of their COVID-related economic losses, or it's really just more kind of to keep things going forward as for more ongoing operational costs. But again, your local lender, if you have an existing relationship with the bank, or reaching out to the county through Worknet, as David mentioned, they can help kind of walk you through some of that menu of options and find out what's best for you.
I think David Marioni would like to chime in on this one too.
In regard to the question about subcontractors and only using subcontractors, what we have seen is if those subcontractors are now going to the state website to try to collect unemployment insurance via the pandemic unemployment assistance, they are offered the opportunity to go on and submit their information to see if they should have been classified as an employee all along. So please note that the state is looking at employee classifications in response to AB5 very seriously during these times. So just want to put that out as a word of advice and possibly of caution.
Thanks, David. Our next question comes from Michelle, who asks, I received an advance on an EIDL loan deposited into my business account. So what is next? Do I go to my local bank and ask for a loan? How do I know how much to ask for? Thank you.
So for the advance, that's usually the the emergency economic grant that would come as part of the loan process. I think again, going to the bank is the best bet, and they can kind of walk through that process for eligibility, for amounts, scheduling. I think that is definitely the first place I would call.
Okay, our next question comes from Nick. Our business is 2 owners and 2 part-time employees. We are currently forced to be closed. What is the best loan for us to pay our salaries, rent, and utilities?
It's a good question, and I would give the same answer as the one just before that David helped answer. That I would check with him, with their resources, and then check with your local bank. It's likely not going to be PPP. It sounds like payroll is not the number one factor there. One of the conditions, even though it can cover other things like rent and utilities, is that they want it to be 75-25 issued to payroll. And so that may not be the best fit, based on the circumstances. But even then, and with it closed now, that's not going to help you in the short term. Hopefully there's more money in that, but in the very near term, I would reach out to your local lender and find out which one they would recommend out of that list.
Okay, our next question comes from Monica. We are a small nonprofit with 5 employees. 4 of them have children, and we had to reduce their hours to care for their children. They applied for unemployment. Was that wrong? How should we handle it now?
So they've applied for unemployment. So are they still on, and it's not clear if they're still on payroll or were furloughed entirely. You want to make sure that they're not let go for requesting the leave. That's a very clear no-no under the Department of Labor rules. And they would treat that as retaliation, unfortunately. It could be that it's a better option for the worker to receive unemployment, and so that's something you can have as a discussion, but just be careful that it doesn't look as though you're terminating them for asking for it. To the extent they're able to work a partial schedule, they could get paid for the time that they're able to come in and then receive the 2/3 pay reimbursable again through IRS, so not at the employer expense, to cover that additional time when they would have come in but now couldn't because of this. So if their normal schedule was say 4 days a week and they could only work 2 days a week, they could get 2 days of pay and then 2 days at 2/3 pay through IRS to cover that difference.
Okay, thanks for that. Our next question comes from Bart, who asks, what loan would be best if we had to expand under these unfortunate situations, possibly add employees?
Again, I think that goes back, to the types of loans. And I think your best bet is to have some discussions with your local lenders on which tool from either SBA or Treasury may be best. And also may want to reach out to the county as well.
Yeah, and so assuming that they're 500 or fewer, Emily mentioned that the 7A and I think the 504 loan can cover expansion of the business. So that could be physical expansion, kind of building on, but it may cover increases in operating size. But you should check with them. PPP probably wouldn't cover because it wouldn't, to the extent that you have more employees at the end than you had last year. You only get the loan forgiveness to the extent that you're kind of holding level to where you were before. So say you were operating with 70 employees last year and you're able to grow to 100 now, you would only get the forgiveness credit for 70. So that would only partially cover it. So to the extent that you're looking to expand, those existing SBA loan programs could be helpful there.
And this is David. I'd just like to add that, if you are in the position now to add employees, Worknet would love to help you fill that, as we do have qualified job seekers looking to work right now.
Okay, our next question comes from Laura. If you have a pregnant employee and the doctor has to quarantine until delivery, would she apply for unemployment or would she be better under the sick pay rule?
And so if they're under a doctor's order to quarantine, again, it's likely not infected by COVID, but if it's reported as a medical provider has ordered them to quarantine, the sick leave rule would provide 100% pay for that 2-week period, but only for that 2-week period, unfortunately. The Family Medical Leave Act has limits for, and that is still in place. This added to it, but didn't take away from it. They would still be, they would hold the job open until she came back from delivery and maternity leave, but that pay would normally not be paid for that time period, unless there's a policy for paid leave from the company, or the state law requires some part of that. But again, the employee may be better off on unemployment as it's been expanded under the CARES Act, but you want to be very careful that it doesn't look to anyone, and that's obviously not what's happening. You want what's best for the employee, and they want what's best for them and their family. But if that you're not terminating them for asking, or God forbid, terminating them for being pregnant or something like that. I mean, that's not what's happening, but that would open the door to, all kinds of liability. So if that's what's best for them, and you actually are legitimately downsizing that position, then that's something that, they may, it may be better for them to be paid through the state system. But, there is coverage for that, at least for that 2-week period under the FFCRA, reimbursable from IRS. So it may be a combination of things and kind of what's best for them to meet their medical situation and their employment situation.
Okay, thanks. It's 4 o'clock, but I want to just pose one final question. And this last one comes from Stephanie, who says, our business is listed as essential, and we have been trying to stay open and have not let anyone go yet. Our bank could not do the PPP loan. We found a bank to help us apply and was submitted 3 days ago. Will I need to look for another loan since the funds were exhausted today? Will our loan still be processed through the PPP program?
I would check with the bank on the specific timeline of yours. The indication today was that they would no longer be processing ones after they indicated that it had been hit, but just make sure that you were not already funded for it. So that's step one. So if you were able to get completed and get that fund, that's congratulations, that's awesome. If not, then absolutely, I would start looking for other things. Hopefully there'll be more funding for PPP, but they may not overlap. I mean, some of these other programs, as Emily mentioned, to the extent you can get this emergency loan and the emergency grant, then that just gets factored in and is just sort of part of your payback of the PPP loan that you could get down the road. So both of those conversations, though, would go to the same place. Go to the bank and find out kind of where you stand on the PPP. And then one way or another, you'll know kind of what gaps are there and what you'll still need to do, and then reach out to them to see what other options are available to cover some of the other operating costs.
Okay, thank you. And that comment concludes our webinar today. If we were unable to get to your question, there's a few that we couldn't get to. Again, please feel free to email it to business@worknetmerced.com. Once again, that's business@worknetmerced.com. And a big thank you to our panelists today and our participants, and have a great day. Thank you, everybody.